I'm Daniel Schwartzman, Director of the Seeking Alpha Marketplace. I'm joined this morning on April 9th, Thursday, April 9th, by Andres Cardenal, author of The Data Driven Investor, a service that aims to provide time proven quantitative stock picking and market timing indicators. So, Andres, good morning. How are you?
Hello, Danny. Good morning. Thank you very much for having me.
It's a pleasure. So, you recently participated in a tech roundtable. You write a lot about tech companies. My question to just start is one of the arguments you made was that tech trades at a premium valuation, and it's going to prove these stocks are going to prove that they deserve this valuation. I wanted to get into a little bit more. Why do you think that's the case?
Well, this is actually what has been going on in the market because if you think about it, you have expensive valuations in technology and cheap valuations in sectors such as financials or energy. And then you get the bear market, and what happens is that they get stronger because technology stock is holding on much better than financials or consumer discretionary or energy. And I think that the key factor here is the quality of the business, because in technology you have a lot of big companies with a lot of cash flow generation, very valuable brands. If you consider, Apple, Microsoft, Alphabet, Amazon, those they are not necessarily in the tech index, but they are mostly tech businesses. So you have very strong brands, very strong business models, and very healthy cash flow generation with also pristine balance sheets. Most of these companies, they have cash in the balance sheets, they have no debt. So valuation is not about just looking at the price to earnings ratio. It's about considering the overall quality of the business, how much is revenue growing, what level of profitability the company produces, what level of cash flow the business generates. And when you bring all that into the equation, I think that through the ups and downs in the business cycle, tech is going to command a valuation premium versus the rest of the market.
So, a quick follow up on that is so far it's been impressive that the Nasdaq has dropped less than the rest of the market. Do you think that means that we'll get into later about what sort of where we are with the market as a whole, but do you think that means that when we rebound, we've already started to rebound quite a bit, but when we finish rebounding, maybe tech gets less upside because it's been safer? Like, is it now a safer area and thus a less exciting area, or do you think it'll still bounce back quite a bit?
Well, I think that depends on the time frame, because when you look at previous bear markets, technology has always been a leader in the first stage of the recovery. In this particular bear market, technology is holding on better. And I think that if things start to improve now, you're going to see stronger returns in sectors such as consumer discretionary, for example, or energy if oil prices remain strong, because mostly they are really, really beaten down. So in the first 1, 2, 3 months of a recovery, you can get stronger returns in the sectors that are more beaten down. But if you look at 1 year or 3 years, for example, over the middle term, I think that there is a big chance that tech is going to continue among the best performing sectors in the market, because you first get a big surge in stocks which are undervalued. But over time, I think that this market is looking for growth in a world in which you cannot find many growth opportunities. Most of the best growth opportunities are in tech. So I think it is very likely that the cheapest sectors are going to deliver bigger returns in the first few months of the recovery, but over the middle term, I will stick with technology.
Okay. So then a question on sort of, I guess you call this middle term, is you said a lot of these tech companies are really different. Apple, you could say, is a consumer discretionary. Google is or Alphabet is an advertising company. They're tech, but that's sort of just the category how they deliver their services. Advertising is likely to be hit heavily. It always is in a down cycle, and digital advertising is not new, so it's not that they can gain share as easily. The same would seem to go for consumer discretionary. We're less likely to spend for that really expensive phone because we may not have as much cash as a consumer. So I'm just curious, how are you thinking about that as far as the cycle and the fact that we do, whatever is happening with the market, we do have a real economic hit happening right now. So how are you thinking about that for these tech companies?
Well, I think that the companies that are related to advertising, they will take a hit to revenue. They're going to see a big acceleration in growth. In some cases, maybe a decline in revenue. That remains to be seen. But on the other hand, I think that online advertising is going to hold on much better than the broad advertising business. For example, we have heard about from the CEO of the Trade Desk, which makes programmatic advertising, and he said that the companies are increasingly focusing on advertising that you can measure. They want to know what return they are getting for their advertising spending, and online is much better than traditional media in that area. So yes, advertising is going to take a hit, no question about it, but it's going to recover. And the impact that the advertising companies are going to have on revenue is going to be mostly transitory. I mean, Google, Google and Facebook, they're going to take a slowdown in revenue growth, but they make massive amounts of cash. And the stock, they are attractively valued right now. If you look at Alphabet, for example, it's trading at a forward price to earning ratio of 25, and Facebook is below 20, I believe. So you're paying very reasonable prices, even assuming that there's going to be a slowdown in revenue growth. The Trade Desk, it's been quite volatile recently, but you have the CEO of the company saying that the clients are increasingly focused on programmatic advertising. So at the end of the day, through the ups and downs in the business cycle, I think that these companies are going to emerge stronger than they were before, even if they take a transitory hit to revenue, right?
Okay. So let's talk about a couple stocks that you have mentioned recently, both in the roundtable and in other articles that you like, not actually related to the advertising market, but you recently published an article about DocuSign and also Twilio, and those are not so well known names. I think investors may be aware of them, but why are those two names that are on your radar right now?
Well, DocuSign, they started with digital signatures, and then they're expanding to full contract management. So it's the kind of company that you would call anti-fragile. It's not only going to survive the crisis well, it's going to emerge stronger from this crisis, because a lot of companies are going to start to bring their paperwork online. And DocuSign, they allow you to have spectacular security features. And they use blockchain technology to guarantee who signed what contract, on what date, what modifications were made. It has legal value. So it's actually a widely superior way to manage your paperwork than doing it on paper. So I think that during the crisis, lots of companies are going to move their paperwork online. And once the crisis is over, they are not going to go back to paper. So DocuSign, the stock is not cheap at all. It's probably trading like 10% below historical highs, but it's going to get stronger during this recession, and it's going to come out of the recession in a better than ever shape. And then you have Twilio. It's probably different. Twilio will probably take a hit on revenue. The company makes the building blocks for online communications. So for example, when you send a voice message, and when you get a notification from your Uber driver or from a restaurant about the reservation, that's powered by Twilio. And they're growing revenue like at 50% in the previous quarter. And I think all companies around the world are increasingly conscious about how important it is to have the right communication and engagement tools with your customers, especially through digital channels nowadays. So it will probably take a hit to revenue because it has a lot of clients from different sizes, and corporate spending will probably slow down during the recession. But this is another company that, and Twilio is much cheaper than it used to be. It's more than 40, 50% below historical highs, and it has a lot of cash on the balance sheet. It probably has cash to cover like 1 year or two of expenses with zero revenue, and revenue is not going to zero because a large part of revenue is recurrent. So Twilio is another company which I think it's a good candidate if you can tolerate the short-term volatility in the market, because Twilio is going to gain popularity and is going to prove to its customers that it's a crucial building block in their relationship with customers.
Okay. So for DocuSign specifically, one thing I liked about your article is you pointed out it's already a profitable company, so it's already it's not burning cash, so that gives it more room, even if things go badly. And what I wanted to ask is, how do they look competitive wise? Is there any risk of any entrance or anything you're seeing? Because it stands to reason that this is a trend that could stick after the current period, which is I think what investors are probably looking for. But what what is to say that a bigger company doesn't get involved and all of a sudden attack them?
Yeah, competition is a relevant risk factor to watch here because DocuSign, they are market leader. They started with digital signatures and they are expanding to broader services. They have smaller competitions, which are also starting with signatures. And Adobe is a big player there because the company, it's really well known in document management. And they're both companies, they're starting to step into each other's businesses. So I think competition from Adobe is particularly relevant in the case of DocuSign. But the business model, it has strong switching costs. Once a company is managing all the paperwork with DocuSign, it is very unlikely that they're going to go to another supplier because that is risky, that is expensive. So I'm not so much worried about the impact of competition on the company's current business. But when it comes to long-term growth opportunities, you have to expect that competitive pressure is going to increase, and DocuSign, they need to stay on top of the game if they're going to win that competition. Absolutely.
It's interesting as a situation like this really puts stress on which services are really vital, and the point you made about DocuSign becoming increasingly accepted as a legally valid way to manage contracts, it becomes all the more important, and that may be what keeps those switching costs high and gives them a competitive advantage down the line.
Oh, absolutely. Yeah, it's that, and it's also security, because companies, when you have to change a supplier and security is involved, you're taking a major risk in case something goes wrong. So I think that they need to spend a lot of money on research and development to make sure that they remain at the forefront of the industry. But once you are the leader, you have some advantages there.
And with Twilio, what I wanted to ask about is your sense on one of the hard things here is the second level, third level effects in terms of, let's say, small businesses are closed, so they're not able to advertise on Facebook, or the travel industry is not advertising on Google. And so that's where, like, you have those second, third effects. In Twilio's case, how much do you have to think about who their customers are and whether they're going to be sending less messages, or whether that's going to be, I mean, I understand the point of long term, their balance sheet is fine, but just how much do you worry about that or think about that in the months and even years ahead?
Well, they have significant concentration in large customers. For example, WhatsApp is the largest customer, and they're not going to see a significant decline in revenue there. But they also have small businesses in areas such as restaurants, for example. And, restaurant reservations, that business is completely frozen. So I think that when you start to look at it, they are also getting new customers in areas such as healthcare, for example. A lot of companies that are building telemedicine applications and notifications for patients when you need to visit your doctor and such. But for the most part, it's going to be a negative. Probably when you have to look at the trajectory of growth, and they delivered revenue growth above 60% last quarter, and their customer retention rates, they are about 130%, meaning that they not only they retain their revenue per customer, but they make 30% more per year for the same customers. So when you bring all that into the mix, I think probably revenue can stay the same or decline a little bit, but the probabilities are that they're not going to see a significant decline in overall revenue. That's going to depend, of course, on the mixer. They have some fixed contracts with some clients and variable contracts with other clients. So it's not easy to exactly measure it, but I think that it's likely to assume that if revenue declines, which remains to be seen, if it's negative, it's going to be less than 15 or 20%. And the company, the CEO said in the last earnings conference call, we could have turned the profit this quarter, but we decided not to do it because we have enormous room for growth. So we're aggressively investing for that growth. And this is very different from a company that needs to put a lot of capital to work quarter after quarter to produce the product. Because at the end of the day, if you're in a recession and you need to conserve your cash, you can put your foot off the gas pedal and you slow down the growth, but you don't need to issue more stock or issue any debt to get the cash flows. So it's I'm expecting a slowdown in growth, maybe a small decline in revenue, but they should not need any outside capital.
It's interesting because obviously SaaS companies existed in 2008 and 2009, but not to the degree that they are now on the public markets. And so this is really our first test of that model on a wide level. And that's where all the things you mentioned, variable contracts versus fixed contracts and net dollar retention rates and all these other things really become important. And so it'll be interesting to see. That's where the fundamental analysis really gets valuable again, in understanding what you own and all those things.
Yeah, absolutely. I think this recession is going to be crucial for the software sector because for the most part, investors have always been worried about what is going to happen to these high growth stocks during a recession. And the best ones, I think the really good ones, they're going to prove to the market that they are becoming a necessity for the customers. Like you cannot reduce on your cut your spending in your relationship with your customers, in your relations with your data analysis. In many cases, these software companies, they help you reduce costs. So DocuSign, for example, it's not only more efficient and faster and more secure, it reduces your costs. So I think most of the clients, when they face a recession and they need to keep the business as clean as possible, they are not going to cut their spending on DocuSign. They will probably reduce, they want to try to cut the fat and not the muscle. So probably they're going to be benefited by the trend towards increased productivity and reduced costs.
Okay, very interesting. A last question for you, Andres, is you've been writing about how, and I checked on your service, you started raising cash in January, and talked about the market being overbought. You also wrote an article about Corona being in the air in late January before it really conveyed itself to the U.S. and U.S. investors' mindsets. My question for you, we're talking on April 9th, and the market has recovered a lot of what it's dropped off. It's really only down about 17% using the S&P 500. Not to pin you to a market prediction, but how are you thinking about the market right now? What are you watching for as this unprecedented situation continues to play out?
Well, I think I raised cash in January because there was just too much optimism in the market. And when you have a lot of optimism, people tend to overlook the risk. I really didn't know that coronavirus was going to be such a massive hit to the market. But when too much optimism, bad things tend to happen. You know, everybody was expecting sustained growth and low interest rates, and the market handled the crisis with Iran very well. And when coronavirus was a factor in China, nobody was really worried about it in the United States. So when you have too much optimism, that sets the stage for bad things to happen. I was expecting a correction, not such a sharp decline in the market, but that's what we got. Fortunately, I had a lot of cash. I started putting that cash to work. I went from 50 to 70% in stocks. And then when the market started rising, I raised my cash levels. I think I am currently 55% in stocks and 45% in cash. So this is the way I look at these things. You have to see it like you're playing a poker game. So every time there's a new card on the table, it changes the odds to the upside or to the downside. So back in March, it was becoming clear that we were going to have a big shock to the economy because a lot of small businesses are going to be closed, and that's going to open the door to all kinds of potential problems. Then you have unprecedented monetary and fiscal stimuli. We have never seen the Fed do so much and in such a brief period. So that changes the odds for the better. And then you have the coronavirus data in Italy and Spain, and importantly in New York, is starting to improve. I think that it's quite clear that social distancing measures, they work, they produce the results we need in terms of slowing down the spread of the virus. And the market is reacting to that. And I think very, very important for the stock market to have a framework in which to think for how long the economy is going to be shut down. Because when this whole thing started, you knew that we were going to have a recession. You don't know for how long, and it's very difficult for an analyst to tell what's the true value of a stock if you don't know for how long the economy is going to be shut down.
Right.
So once you start to have a framework, like saying, okay, it's a matter of weeks and months, and it's not a matter of several quarters that we're going to keep the economy shut down. Even if you get new contagions in other states of the country, the fact that New York is getting results. When you look at new contagions, you look at the ICU beds, you look at the broad data, it is clear that the measures they are working. So that's changing the odds again. This card is saying to me that okay, we can control this. You always know that you can control this, but it depends on can you handle the time frame. And it looks like the time frame is manageable. So most of the time when the market it makes a sharp drop, it tends to make a relief rally and then a long frustration phase with a lot of volatility, sideways volatility, until things start to settle down when you see volatility decline, and that sets the stage for the sustained recovery. I think we already had the shock to the system, the massive decline with a lot of panic in the market. Then we had a strong relief rally, maybe it's been happening until yesterday. And it wouldn't surprise me to see a phase of a lot of sideways movement, frustrating stock market action for both the bulls and the bears, until slowly volatility should start to decline. Maybe not, but maybe we see a retest of the lows. That wouldn't be surprising based on history. Most of the time, when you get a sharp drop, you get a relief rally, and then sideways volatility with a retest of the lows. We had the decline, we had the relief rally, and we're getting the sideways volatility. Will we get the retest of the lows? Nobody knows for sure, but this is a possibility that you need to consider. So that is why I am keeping lots of cash in my portfolio, because you cannot predict the future. You have to make plans for different environments. So if we see a decline to the lows, and you see that selling pressure is slowing down in that retest of the lows, that's a big buying opportunity. Alternatively, if you see prices fluctuating sideways and the underlying breadth in the market getting better, I can probably tell you that perhaps we're going to see a recovery and not necessarily a retest of the lows. So it's all about watching the cuts, watching the evidence, the price action from the market, and you place your bets by probabilistically thinking about different scenarios.
Obviously, your service is focused on, as we said, a quantitative approach and looking at time-proven models. And it's interesting to me, and maybe I know I said last question, but maybe a follow-up is
Sure.
all of that sounds good on paper, but we all know the feeling. I'm, for example, pretty defensively positioned, but I am probably close, maybe even more cash because my stocks have dropped in value. And you watch the market this week, and it's very hard to not feel like, oh my gosh, I've missed out on my chance. And likewise, in March, you think, oh my gosh, I was such an idiot. Why did I have this position or that position? I should have gotten rid of it months ago. How do you manage those emotions within the context of what has been, for all that it's only a 17% drop, it's been a pretty fast moving market. How do you kind of make sure that you don't get too hard one direction or the other?
Oh, I think the first thing you have to do, you have to fully acknowledge that nobody buys at the bottom and they sell at the top. That's simply unrealistic. And if you try to do that, you're going to hurt your performance much more than if you try to be realistic and stick with the evidence. I think that the best thing to do is to have plans. For example, when the market started declining, I was saying, okay, I have 50% in cash. For every 10% drop in the market, I'm going to put 10% of my capital to work. So it's a very simple rule. It's basic, and it's not going to hurt you. You're not going to assume a lot of leverage. You're not going to make serious mistakes by doing that. And then you said, okay, if we get a rebound, I'm going to start trimming the positions in case we get a retest of the lows. So you follow that plan. For every 10%, you say something. And then you say, okay, but at some stage, the trend has changed. For example, if you have 20% of the stocks in the S&P 500 trading above the 200-day moving average, which is a long-term trend measure, then you're in an uptrend. You're no longer in a bear market. You can increase your exposure to, let's say, 70%, a number that you're comfortable with. I think that at the end of the day, you have to have a very basic system to manage portfolio risk. It has to be proven by long-term data and very basic, so that you don't think about it twice. And you have to acknowledge when you first begin that the system is not going to be perfect or infallible, but it's going to be much, much better than making decisions based on emotions, fear and panic and speculation. That doesn't work. We know that it doesn't work. So you have to build solid rules, simple rules that have proven to work in the long term, and fully acknowledging that none of those rules are going to be perfect. You will never buy exactly at the bottom and sell exactly at the top. The good news is that you don't need to do that. If you avoid the big mistakes and you have a reasonable risk management framework, you're going to get very strong returns over the years. So you don't need to worry about the perfect timing. You have to have a solid system for a bull and bear market. That's the most important thing.
Okay, that's why words of wisdom for sure, and I think useful. It's useful for me to hear, and I'm sure it's useful for any investor to hear. So, list viewers can find your service on the Seeking Alpha Marketplace. Andres Cardenal, the data-driven investor. Andres, thank you so much for joining me this morning, and best of luck and stay safe out there.
Oh, thank you for having me. It's been a pleasure. Stay safe.
Okay.